Good morning, listeners, and welcome to this, the third in our deep dive webcast series. My name's Mark Stubbings and I've got the pleasure to be your host this morning. If you've joined us for previous webcasts, you'll recall that up until now we've already done two. We've had the property webcast, our first broadcast, followed by our infrastructure, and the recordings for those are actually on our website. If you care to check out the Sunsuper website, you'll find them under the Advisor Webcast tab. Alternatively, you can contact the business development team and they will be more than happy to help you. Today we're here to discuss private capital. And what I'm going to do is introduce our speaker shortly, James Lillico, who's the portfolio manager. What is the purpose of these webcasts? The purpose of these webcasts is obviously to give a deep dive into some of the asset classes that Sunsuper invests in. We live in particularly troubled times. Obviously we have a COVID crisis and the economic consequences of that. We're trying very, very hard to be very open and transparent with regards to our assets, because obviously we receive a lot of questions, as most of other fund managers. What we got coming up after today's webcast? We've actually got two further ones. One will concentrate on our alternative strategies, and the one after that will concentrate on our equity holdings, including our index options. What to look forward to today, just in terms of an agenda. What I'm going to do, as I mentioned, is introduce shortly James Lillico, the portfolio manager, and James is actually going to talk through a bit of a foundation slide pack, which will give some idea of the objectives of the portfolio and holdings. We then go on to some questions that we've already received prior to now, and James has obviously had the benefit of preparing for those questions, and he's going to walk through some, as mentioned, prepared answers. We're then going to go live to our live questions on the webcast, and I've got the pleasure to be joined today by Will Burke, who's going to curate the questions for us. If you care to look on your screen, bottom right hand corner, there is a speech icon and you can literally submit live questions. We encourage you to do so. Please, if you could, if we don't get to the questions because of the crush of time, please put on your name and email address and we'll make sure that the business development team gets back to you to answer those questions. Also be aware, if you have any technical difficulties, there's an eye icon there which you can click on for that. Just in terms of a disclaimer, we are legally required to remind you that today is for general information. Obviously it doesn't deal with specific client situations or financial goals. Let me now introduce James, our speaker, James Lillico. James joined Sunsuper in 2010 and in actual fact became the portfolio manager in 2018. After a pretty distinguished career with RMB Capital Partners and Grant Samuel, obviously James joined us. James has a Bachelor of Science and a Master of Science degree and is also a CFA. So now I'll pass over to James for his foundation presentation.
Thanks, Mark, for your kind introduction. We have roughly about almost $5 billion invested in the private capital asset class, which represents about 5 to 10.5% of our major diversified options. It's also 35% of the diversified alternatives option. So what is private capital? Well, some investors will refer to it as private equity, which typically encompasses buyout and venture capital. We call it private capital because we're actually targeting a broader opportunity set. We essentially will, anything illiquid where we can expect to get a return that's at a premium to listed equities, we will consider for the private capital asset class. And if you look at the slide, that means that there's a broad variety of categories we can invest in, starting with buyout, which is perhaps the most well-known of these categories. When the media refers to barbarians at the gate, they're typically referring to buyout, which is essentially using debt and equity to buy an established business with a view to growing the company and with a view to selling it or listing it in a few years' time. A recent example of this would be KKR buying 55% of CFS off CBA Bank, of the CBA. Next, you have venture capital, also a sort of well-known sort of strategy where you're essentially backing entrepreneurs to start up new companies, providing them seed funding to get off the ground and grow the businesses. So Google, Amazon, Microsoft wouldn't be where they are today without the backing of venture capitalists. An adjunct to this is growth equity. Growth equity is when you've got a company that's gone through the startup phase, it's been de-risked, it's more established, it might be profitable, but it needs additional capital to get to that next level, whether it's expanding into new geographies, market segments, or different different product sets. This has been an area that's seen a lot of fundraising growth over the last 20 years, and it's one of the reasons why companies are able to stay private for longer nowadays. Where historically companies would have IPO'd to access expansion funding, now there are a lot of private sources of growth funding available to them. So you can see companies that will stay private for a lot longer, and the IPO market is viewed more as a liquidity mechanism for those sort of companies. Finally, you have special situations and distressed debt. This is when you have more mature companies who've gotten themselves into trouble, whether it's a cyclical downturn or they've got too much debt. The special situation investors and the distressed debt investors are there to sort of help provide funding, whether a special sits investor might provide rescue financing or recap a company, or you have distressed debt investors who will purchase debt off existing lenders with a view that to convert that debt into equity to create a more sustainable capital structure for the business going forward. And with that more sustainable capital structure, their equity should be worth more. These are all different types of strategies, but they all share common characteristics. They're typically unlisted, the private and private capital. Being unlisted, they are illiquid investments. We're not expecting to invest in these companies and sell them 1 month later. When we do direct co-investment to a company, we're underwriting a 3 to 7 year hold period. When we commit to various funds that the managers raise to invest in these types of companies, the funds typically have a life of 10 years plus. As well, that means that it's a long duration investment. When we invest in these funds, they're typically blind pools. We don't have control of what goes into them. We don't actually know what's going to go into them. It's about picking great managers who can find great investments to put into the funds. As such, the capital outlays over time are typically at the manager's discretion. They also tend to be concentrated portfolios. So the funds will contain about 8 to 12 companies in each fund. Finally, unlike property and infrastructure, this is a portfolio or asset class that's focused on capital gain rather than yield. So that's a little bit of overview. So why do we like private capital? So next slide, Will. As I've already said, we're looking to get a premium return above listed equity markets. And so we're investing in both equity or debt instruments. Secondly, private ownership allows us to access control positions in small and mid-cap companies, which is a more inefficient part of the market relative to large caps. It's also a faster growing part of the market. It's easier in many ways to find companies that can grow from $100 million in value to $200 million in value than it is to find a company that's worth $10 billion already and then try and grow that to 20. Finally, the structure of our private capital investments means that managers are strongly incentivized to grow value. Managers are entitled to performance fees, but that's only after they sell the company and return capital to investment and to investors. As such, they're strongly incentivized to find great investments, grow them, and then sell them, return the capital to us before they can actually collect their performance fee. In the same way, they incentivize management teams within those companies to grow that value, and the management teams if the company does well can be very well rewarded. In terms of how we benchmark ourselves, we're targeting our performance against the MSCI AQUIMI. This is hedged into Aussie dollars. We hedge all our investments. We're not looking to play currency. It's more about the underlying performance of the investments. And we measured over rolling 7-year periods because these are longer duration investments. Finally, our KPI benchmark it's a pair relative benchmark. It's essentially a private equity index composed of a lot of different private equity funds and co-investments. In terms of our own portfolio, if you look onto the next slide, in terms of geography, it's a globally diversified. We have a globally diversified portfolio with less than 10% in Australia and New Zealand, which is representative of the global opportunity set. The majority of the portfolio is in the US. That's because it's the largest, deepest market for these private capital investment strategies. It also is the geography with the longest track record there. We have exposure to Asia and Europe as well, and we're actively trying to grow our exposure to Asia, to give us more access to those faster growing economies over time. In terms of the strategies, which I've talked about, our portfolio is predominantly buyout. That is main reason for that is because the largest part of the US, European and Australian markets is buyout. It's also a large component of our co-investment strategies. It's harder to we will do some co-investments in venture and growth, but it is those are typically smaller investment sizes. Venture and growth and venture are two areas we'd love to grow our exposure to over time. We're actively looking to grow them both. As we grow, Asia is mainly a growth equity market. As we grow our exposure to Asia, we expect our growth equity exposure to grow over time as well. Venture capital is another area we'd like to grow, increase the exposure, but it's also the area where manager selection is the most important. Typically in venture capital, if you've got entrepreneurs, they want to be backed by the best venture capitalists because it does provide a stamp of approval for those entrepreneurs in terms of their business plan and the viability of their startup. So entrepreneur would like to say, I've been backed by Sequoia Capital. It's a very, very well-known global VC, and it provides and it attracts other funding from other potential funding sources. And so what happens is those venture capitalists, the entrepreneurs go to those venture capitalists, the best ones see the best deals first, they get the best deals, they build the best track records, and the next generation of entrepreneurs then wants to be backed by those same venture capitalists and becomes a virtuous circle. So unless you can access the top tier venture capital firms, it's not an area you want to allocate large amounts to. We have been successfully allocated to groups like Sequoia. We also have been a backer of Airtree locally here in Australia. In terms of our sector allocations on the next slide, we've got a well-diversified sector portfolio by sector. We're not looking to have too much concentration in any one sector. We're looking more at characteristics of businesses rather than saying, well, we want to have so much in consumer or energy. It's more about finding great defense businesses where we've got visibility of income rather than looking, trying to avoid sort of cyclical businesses. And you can find those in all different types of sectors. In terms of how we've actually done, on the next slide, we've got to compare our private capital asset class performance against listed markets. So the listed market is a blend of 50-50 Aussie and international, which is a typical sort of equity allocation for investors here in Australia. As you can see, over time, we've managed to outperform those listed proxy. There is obviously a downtick at the end. A lot of volatility with COVID. We actually preemptively reduced our valuations in the asset class ahead of what we thought the managers would report for the March 31 quarter. Pleasingly, as we've gotten results in from managers, the results have actually been tracking ahead of what we thought the downward reval would be, which has been pleasing for us. Finally, the last slide. This is a slide I love like talking about because it does show one of the reasons why we invest in private capital. So we have a graph that shows the number of companies listed in the US according to the Wilshire 5000. The Wilshire 5000 includes all US equities with readily available market pricing, so it's actually a very good representation of the US listed equity market. Over time, the number of listed companies in the US has declined quite substantially, almost halved. I mean, the last time there were 5,000 companies in the Wilshire 5000 was 2005, 2006. So now there's roughly only about 3,500 companies listed in the US. This is compared to the US economy where there are over 100,000 companies that have 100 or more employees. So there are a lot of small and mid-cap companies that have never been listed and might never be listed. It provides an ample opportunity set for private capital investment strategies to play in. So it really, and that's proven out, you've got almost 10,000 private equity-owned companies in the US now. And there's still ample opportunity for them to invest. I mean, some people ask about dry powder and like whether too much money's been raised in the private capital investment strategies. Well, the private capital globally probably represents about $6 or $7 trillion US of invested capital. That's compared to global listed markets, a total market cap of roughly 75 billion US. 75 trillion US globally. Now, so invested capital is actually a very small subset of the listed market, and it's then, it's very probably an even smaller subset of the global unlisted market. And on top of that, the dry powder is only about $2 or $3 trillion on top of the sort of $6 or $7 trillion invested. In terms of the actual deal sizes we're talking about as well, the median buyout size in the US is 250 million US approximately in 2019, compared to the median market cap for the Wilshire 5000 in 2019 of about US $700 million. So we're talking about deals that are a lot smaller than what's happening in the listed market. And with that, I'm happy to go back to Mark for Q&A.
That's excellent. Thanks very much, James. Very informative. I'll take the opportunity to just remind viewers that the webcast is obviously live and the opportunity for you to submit questions. We have had the benefit of some questions being sent in prior to today's events, which has allowed us to prepare for these. So what I'm going to do is go to some of the pre-submitted questions and get James to comment on those. James, tell us a little bit about the due diligence process for, say, purchasing a particular asset in the portfolio. Can you talk us a little bit through what's involved there, please?
Sure. I mean, this is one of the great advantages of private capital is we are allowed to do a lot more detailed due diligence on companies relative to what you might be able to do in, say, the listed markets. So we have a little case study here. We've got IntelliHub, which is an investment, direct co-investment we've made in our private capital portfolio. It's a local company. It is a carve-out essentially from Origin Energy, and it's a smart metering businesses. So what this business does is they install, they maintain, and they record the data for various energy retailers for smart meters. So as the old electricity meter in your house needs to be replaced, it gets replaced by a smart meter that allows for more efficient billing and usage of electricity in households. We're attracted to this business because they essentially sign very long-term contracts with providers like Origin and AGL and other energy retailers. This is a deal where we actually co-underwrote it with the manager. The manager was looking to raise a new fund to pursue these types of investments. The fund wasn't raised yet, but this opportunity came along. So they asked us and some other investors to help them warehouse the investment. So we took it, invested into it with the view that part of it would be sold down to the fund when it was raised later, and we would continue to hold a direct stake alongside that fund. In terms of the sort of DD process that was involved with that company, it's a very detailed, start out, you have a lot of management meetings with management, you understand their strategy, where they see the opportunities, the challenges within the business. It allows the private equity manager to assess the management team, work out, okay, are there gaps? Do they need to actually recruit or supplement that team or replace them if necessary? And then you have the various external consultants that are also brought in to help with the process. So you have financial DD that takes place. You bring in a big four accounting firm, a KPMG, EY, PwC, to do financial and tax DD, look through the revenue, the earnings, cash flow, understand the level of working capital that's required in the business, the seasonality of earnings, what the true level of earnings is. Are those one-off earnings adjustments really one-off, or should they really be considered part of the maintainable earnings of the business? On top of that, you get legal DD done by lawyers, look at all the sales contracts, employee contracts, liabilities, financing agreements, IP rights, potential litigation liability. So you get a really good understanding of what the potential legal liability of the company might be. Then you bring in strategy consultants to do commercial DD on the market, understand what the market opportunity is, how the company compares to other competitors, what opportunities there are to improve the operations of the company in terms of, are there areas, things that they could do to make themselves more efficient, or opportunities they should target that they're missing currently. Then on top of that, you bring in specialized consultants. So you might have environmental DD that's done on industrial business to make sure that they haven't got some large environmental liability that people have missed that's sitting there in one of their on a site, say. So specialist consultants as needed. So there's a very detailed process that it goes through. You're talking 2 or 3 months. Essentially, a private equity manager becomes an insider because they're able to really peek under the hood of a company and understand what's going on, where the opportunities are, where the potential threats are, weaknesses, etc. So this is why you sometimes see with public, it's pretty when you see a public to private, where a private equity firm makes a bid on a company. There are a few happening right now, like Village Roadshow and others, where they're doing DD. So they take 2 or 3 months to really look into it before they firm up their offer and able to make an informed bid for the company.
Excellent. Thanks, James. And I guess the other contra is that for every for every purchase, there's a prospective sale. So talk me through a little bit around what's your exit strategy for PE, for private equity assets when you purchase them?
Yeah, if we talk about the next one, like Takala, this is an interesting business. It actually sits within a fund. Any manager, when they go into a new investment, and this is something we grill them on when they're obviously doing DD on the manager, but also when we're considering co-investments, you have to have an idea of the exit strategy. Who's going to be the natural purchaser? What's the natural exit path for the business? Are you likely, if you're a software company, is there a strategic out there that you would typically going to sell to? Is it a listing candidate? is it, would you be able to sell it to another private equity fund that's larger, larger that might be able to take, grow it even further? So this example here is Takala. It sits within one of our funds in the, a couple of funds actually in the US with one of our managers. It's the largest Taco Bell franchisee in the US. It's got over 300 franchisees. They bought it very well. They bought it for like 5.5 times earnings, which is, very cheap relative to what the listed comps trade at. It's a great business, great free cash flow. It has 20% profit margins. The return on capital is fantastic. The growth story here is actually to open new stores. It costs about $500,000 US to open a new store in terms of capex, and once you get back, it gets to a run rate earnings of about 300,000 earnings. So your return on capital employed is incredibly high. So they can open 15 to 15 stores a year, make great returns, throws off a lot of cash. This business, like at some point, yes, there's a lot of people who could actually buy it. There's actually, you can consider, you can sell to another private equity firm who's attracted to the cash flows. You could consider it to sell it to a sovereign wealth fund or even a pension fund who's attracted to the, to get the strong distribution cash flows. Right now, this business is already over 7 years, in terms of just by dividends alone, has returned 4.5 times the original investment. This is without even selling any bit of equity. So literally just distributions have returned 4.5 times what the managers put into it. It's actually an investment where I talk about the 3 to 7 year hold period. This is one where they might hold it for 10 years because it'll just keep throwing off that cash, distribute it until the fund life is pretty much almost over. That's when they'd look to sell and realise it for that. And it would be to one of those, another private equity fund or a strategic buy. Or if it's large enough, they might even consider listing it.
Excellent. And I've got to say, James, that when you mentioned Taco Bell, I was doing my impersonation of Homer Simpson. Might be a little bit of drool, but let's not worry too much about that. So perhaps the last piece, which was a persistent question, what's the valuation process for private equity?
Sure. These these are typically done in quarterly valuations. There is a valuation lag. So what happens is the quarter ends and then the private equity managers will look at how the company's performed and then conduct a valuation based on, obviously, the company performance up to the end of the quarter. There are a variety of measures that they do it, the way they do it. It's typically manager valuations. There are some managers who use independent valuers, but it's typically a manager valuation. And the way they do it is based on looking at the listed comps, listed comparable transactions. They'll do some DCF. And then what will happen is you take your comparable companies, your comparable transactions, and they'll typically apply a discount to that of about 15-20% for illiquidity. In many ways, yes, it is obviously it's managers that do it, but they're only rewarded when they sell the companies, and that is the ultimate test of value, what they can actually sell it at. And that's how they're rewarded. As I said, they don't get the performance fee until they sell the company. And it's actually not in their interest to overvalue a company on the books because it's more common actually. For what happens is when they sell the company, they say, oh, actually, we've sold it for 15% above what we held on the books because all of a sudden you're selling it potentially at what the listed comp is trading at, where they've held it at a discount until that point. They prefer that situation than come to invest and say, actually, we sold it for 10% less than what we were holding it at. And in that case, we're only paying them the performance fee when they sold it and they've returned the cash to us.
Excellent. That's good. Thank you, James. Now, the good news is that we've actually covered off a few of the live questions anyway with some of our pre-prepared stuff. But I'll now take the opportunity to pass over Will for any live questions, James.
Yes, just a quick question that has come in, and that is how has private capital performed relative to other alternative assets in the post-COVID period?
Yeah, well, I guess the post-COVID period is really only a month and a half. We're looking at our portfolio. We're tracking in terms of how the actual companies are performing in terms of liquidity, earnings. We're in terms of measuring potential risk in the portfolio. Pleasingly, most of our portfolio is really, we'd say, if you look at it, green, amber, red. It's typically mostly a majority of the portfolio is in green. We've got about 10% in red where there might be liquidity issues, but most of our companies are well capitalised. In terms of return, in terms of how they've rebounded, actually the portfolio pleasingly has done very well. We talked to managers and some of them are actually, like that Taco Bell example, 70% of that business was drive-through. And so they had to, obviously COVID hit, they had to shut down 30% of the business in the US, the dining part. They were able to keep all staff. They able to make cost cuts, but they didn't actually furlough any staff. They were able to maintain positive cash flow because 70% was drive-through, which is still open. And even with the dining shut and still and reliant only on drive-through, they're actually now back above their budget where they were budgeting pre-COVID, which is great outcome, because when dining opens, hopefully it means that the performance will improve even further. We've had some medical, we had some local healthcare companies that were, struggled a little bit when COVID first hit because people were afraid to go to the doctor or pathology lab, which have come back very, very strong as a result. With whether it's COVID-19 testing or people obviously need to get back and go back and visit the GP. So we're kind of pleased. We're sort of seeing it's not like airports where I guess airports here that who knows when they're going to reopen. We've got very little sort of exposure to that part of the market, transport or tourism or travel. It's mainly being more defensive, and stuff like the industrial and telehub. Well, that smart metering just carried on as was. They had 75,000 meters installed in Q1 of this year, and then a lot of the sectors we look at, IT, software. Talk to the managers. A lot of them actually continue to power on. Some of this stuff in the software business are mission critical. You're not going to shut it down. You're not going to stop spending on that just because people still need to work from home.
Thank you, James. And another question's come in from Vincent, and that is, with the amount of dry powder sitting on the sidelines, how hard is it to actually put capital to work? Is it competitive for the buyout strategies of private equity companies?
It's no doubting that buyout has become more competitive over the years. There are a lot more players playing in it. I mean, good example, software buyouts are big. They're allowed. IT software is now about 40% of deals done in private equity and private capital. If you look back and say 2010, 2012, there are only about 10 firms that specialise in software. Now there are about over 50 who specialise in software buyout. So the market, as over time, as strategies have proven to be successful, it attracts more competition. It's no longer a case where if anyone ever read Barbarians of the Gate, back in the 80s when private equity really getting started out, it was more about buying low, selling high. Can't really do that more. You've got to pay a fair price now, and you've got to find a way to grow the companies, grow the earning streams, find opportunities, yes, whether it's buying or growing organically, are there ways to expand the business organically, or do you have to buy competitors and sort of buy and build, so to speak, strategies, bolt on to grow the earnings base that way and get synergies to create value. So it is more competitive. Managers, ultimately what's happened is that people have become more specialised. So you have got more sector specialists who say, well, I know healthcare, that's my area. That's where, I have my networks. That's where they're able to create value because it's all they do. Or there's, I've seen food, manufacturing, private equity funds. There's software. There's obviously telecommunications, industrial services, GPs. The managers who sort of focus on a certain sector in order to be able to create value, where they have industry advisors, in-house consultants to help them find ways to drive value within companies. But yes, it has become more competitive. In terms of if it's going to be difficult to deploy dry powder, it's going to be interesting for the next couple of years because typically what's happened is that the best time to invest in these strategies has been post-market volatility. So post the GFC in 08, 9, 10, 11 vintages, 12 vintages were very good vintages. We've had some fantastic companies that we had in our portfolio. We made great returns on them. And talk to managers and they say, look, you're not going to buy anything right now in the aftermath of, and while there's still uncertainty, if a company is forced to sell now is in distress, it was probably in distress prior to COVID. But what's really going to be an interesting period is the second half of this year and the first half of next year, where companies who have sort of managed to slog through, might find that, they do need to find a solution, whether it's, to sell themselves or, to find a, recap solution or some sort of rescue financing. So I think there's going to be some really interesting opportunities in the next few years, especially with listed market comps coming down, values coming down. So there might be more opportunity for public to privates as well. And we're actually seeing more, actually in Australia, all of a sudden you're starting to see a few more public to private opportunities pop up. Companies are now on the radar screen of various private equity funds.
Thank you very much, James. And we've come to the end of the live questions, so I'll hand back to Mark to wrap up and final words.
Excellent. Thank you very much, James. And mate, perhaps I could pass it over to you just for any sort of final words, closing remarks before I thank everyone for this morning.
Yeah, thanks, Mark. Look, the private capital asset class is a great way. We think it's a fantastic way to access the sort of small and mid-cap sectors of the market. They're the faster growing parts. They're you're getting exposure to opportunities that might never be listed and you might not be able to find the listed market, especially in some of the software sectors, because especially in IT software, there's a lot of specialised software businesses that'll be within a special niche, very profitable, fast growing, but eventually it might end up being sold to a larger strategic, so it might never ever be listed. And then other ways, there are other unlisted companies that might never have been in private equity hands or listed hands. We saw an opportunity last week for a co-investment where it was a company in the US with 100 million of earnings. It's been still founder owned after 20 years and still growing. And it's never been touched by private equity. It's a fantastic opportunity for a private equity or private capital investor to go in there and sort of try and turbocharge a bit more growth out of it as well. So we look at it and say this is a great way to access diversified parts of the economy that are potentially faster growing and with a higher return ability.
Excellent. Thank you, James, and thank you for the wind-up. Ladies and gentlemen, I'd like to take the opportunity to thank you for listening today. We're pretty keen to make sure that we keep, as I say, our books very open and transparent for you to have a look at what we're up to and how we're investing the money. I'd absolutely encourage you to dial into our next 2 webcasts. We've got another 2 coming up, one on alternative strategies and the final one on our equity holdings, including index. We also have a dedicated web page which will come up on the slide shortly. You, your clients, can access this for particular information around the COVID crisis. What I'd also like give you an expectation that we will send out a copy of today's recording. So you'll see that arrive pretty shortly. We'll also send out registration links so that you can indeed register for the next 2 webcasts. And also there will be a survey for you to do and claim your CPD points. So thank you, listeners. Thank you, James. Thank you, Will. Have a great rest of the day.